Welcome to Biz Money Insights and Strategies. My name is Vanessa. I'm a CPA and I help everyday entrepreneur just like you understand your business finances so that you can make better, smarter, data-backed decisions. Today's lesson is all about learning the language of business, which is accounting. You'll walk away knowing how to use your numbers to take control, make confident decisions, and stop winging it. What is this lesson for? This series was especially designed for online service providers, coaches, freelancers, consultants who are looking to scale past $5,000 a month. However, the core principles apply to every business. Everyone can benefit and gain insights and learn from the tips, the strategies. My only disclaimer is that I will not be going over inventory management, any retail specific strategies or brick and mortar. That's not my specialty. But besides that, all the principles, all the lesson that I will be covering apply to every business. All right, what you'll learn today. Exactly what is accounting? What are the three most powerful statements that as a business owner you have to be aware of, you have to understand, and that you will be reviewing going forward? The difference between cash and accrual and why tracking your numbers is essential. Next up, why financials matter. Accounting is about the story behind your numbers. Do you know what your numbers are telling you about your business? Accounting is very important because as a business owner, your financials allow you to make confident pricing decision, right? Because you cannot price accurately if you don't know the cost of your product. It allows you to plan and catch any red flag and make course corrections early. Let's move to the next slide. What exactly is accounting? Accounting is the process of recording, classifying, and summarizing every dollar coming in and out of your business. So accounting is considered the universal language of business because it literally translates everything that happens in your business. Anyone can gain insights from your financial report. If you look at the diagram here, you can see that it starts with a transaction. It could be a sale or an expense. Then that transaction is categorized, right? If it's an invoice, it will be categorized as a sale. So in this example, if it's a sale, it would go into the income statement. And this income statement will be providing insight as to the performance of your business. How are your sales doing? So in a nutshell, this is what accounting is about, the story behind the numbers. What are the three core financial statements important for your business owner? First up, we have the income statement. The income statement shows the revenue, expense, and the profit of the business over time. Next up, we have the balance sheet. The balance sheet is a snapshot of how much your business is worth at a point in time. In the balance sheet, you find what the business owns, the assets, what the business owes, the liabilities, and whatever is left is the equity, is how much the business is worth. The last report is the cash flow statement, which is a very important report because it's tracking the movement of cash in and out of the business. The cash flow report is tracking the liquidity of the business. Now, who prepares those financials, right? In the early stages, you can use software like QuickBooks or Wave, or you can even track your numbers on Excel spreadsheet. Once you start getting over about 30 transactions per week, it's time to hire a bookkeeper. The bookkeeper will record all the transactions that are coming in and out of your business, and that will save you time. So now, as you keep moving forward and the business keep growing, your accounting becomes more complex. So for instance, if you need tax strategies, if you have a depreciation, then you would hire an accountant. The accountant would prepare financial statements for you, but also analyze your numbers. They can provide different internal reports, month over month variance analysis. Even though as a business owner, you're hiring experts, remember the experts work for you. You still should understand what your financial professionals or telling you about your business so that you can also question. So you still need to understand those concepts and still be able to read the financials as well, right? Once your business starts getting over $250,000 in revenue, it's time to start looking at a controller. A controller will oversee the entire accounting process, the entire close, will oversee the bookkeeper, the accountant, will prepare the budget, and also internal control. So you would hire a controller when you need tighter oversight. Last, we have the CFO, which is the Chief Financial Officer. Typically, once you start hitting $1 million, it's time to hire a CFO. The CFO will help you with funding, with scaling. The cost of flying blind. Flying blind is when, as a business owner, you're not tracking your numbers or reviewing your financials on a regular basis. First up, we have margin leaks. Your margin is the difference between what you sell and how much it costs to make it. If you're not tracking this number closely, you will not be able to capture when your cost is going up, hence your margin shrinking. Next up is cash flow surprises. If you're not monitoring your cash, you might miss large expenses or not be able to meet your obligations. Cash is one of the most important things in business, and the number one cause of business failure is really running out of cash. So it's very vital to meet your obligations. Cash is one of the most important things in business, and the number one cause of business failure is really running out of cash. So it's very, very important that as a business owner, you're monitoring your cash levels, and you cannot do that without looking at all three statements, because each one of these statements is going to provide a different insight about your business. So to successfully monitor your business, you have to be looking at all three statements. Next up, we have missed deductions, higher tax liabilities. If you're not tracking your expenses, there's a possibility that there are tax deductions that you're going to miss because you're not recording them. But if you have inaccurate, disorganized books, you're at a higher risk of getting flagged or audited. Another disadvantage of just flying blind. The last point I wanted to mention is denied funding. If you have messy financials, when you apply for funding, you might get denied, even though your business might be profitable. The reason lenders, when they look at a business that has inaccurate or messy financials, that business is considered high risk, meaning it's not being managed properly. Now that we've covered that, in the next slide, we're going to go over an example of what the margin is, because that is a very important concept that as a business owner, you have to track. This number is telling you, is your business model viable? So in this example, you're going to see if you're selling a product for $100 and it costs you $60 to make it, your margin is essentially the sale price minus the cost divided by sale price equals 40%. So here you can see that you have a margin of 40%. You keep 40 cents for every dollar that you sell. That's what. So it is a profitable business model. Cash versus accrual. When looking at your financial statements, there are two ways of tracking those. So the first way is the cash basis. It's straightforward. Basically, you record transactions when you receive cash and when cash is paid. So this method is pretty simple and it closely follows your bank account. And the second method, which is the more accurate, is the accrual basis. You recognize revenue when it's earned and you recognize expenses when incurred, not when it's paid. The cash method matches your bank account. The accrual method is more accurate because it reflects the true transaction of the business. It's telling you what's going on in the business. We're gonna go over an example just to help you visualize what I'm referring to. A wedding photographer received a deposit from a client in June for a wedding in September. On the cash basis, the photographer is going to recognize the income in June because he received the cash in June. On the accrual basis, this deposit is considered unearned revenue. It's a liability. Why is it a liability? Because he received a deposit and did not perform the service yet. On the cash basis, he recognizes revenue in June when the cash is received. On the accrual basis, he will recognize the revenue in September after he performed the service. On the expense side, let's say you buy a camera in July on your credit card. On the cash basis, because you did not spend any cash, you will not recognize any expense in July. In contrast, in the accrual basis, right? Because when you purchased that camera on the credit card, you did incur the expense, meaning you received the camera. On the accrual basis, you recognize that expense in July. On the cash basis, you recognize it when you pay the credit card. This is a brief overview of the difference between the cash basis and the accrual basis. Comparing cash basis versus the accrual basis. The cash basis is pretty straightforward. So typically, if you versus the accrual basis, the cash basis is pretty straightforward. So typically, if you're startup or you don't have a lot of transactions, it's preferable to use the cash basis because it's easier to manage. However, the accrual basis is more accurate because it's reflecting what's truly going on in the business. And external parties such as lenders or investors typically ask for the accrual basis to see how the business is truly doing. The IRS also has some specific requirements when you reach a certain level of income when to switch to the accrual basis. If your business is complex, you have inventory funding, you should also be using the accrual basis of accounting. Provide a true picture of how the business is doing because it's capturing the true sales and the true expenses. All right, now we're done with this topic. Why is accounting your superpower? Number one, accounting allows you to price confidently. To price your products accurately, you have to know the cost. Hence, you have to track every single component to make sure you're capturing everything so that your products or services are priced accurately. Number two, you're going to use accounting or your financials to make decisions. When you're hiring, when to make large purchases, if you're expending, your financial statements are critical in making plans. Number three, reviewing your financials monthly allows you to catch red flags early and course correct. And number four, it allows you to forecast cash need. Cash is one of the most important aspects of your business because without cash, you cannot keep the lights on. And most importantly, your financials allows you to make smarter decisions. You're not guessing, you're making confident decisions backed by data. All right, so here are the top 3 takeaways. Accounting is the story of your money. It shows where your money comes from, where it's going, and what it means for your business. You have your income statement. Your income statement essentially is telling you how much money are you making. And lastly, you have your cash flow. Cash flow is about liquidity. Do you have enough cash to pay your bills? And lastly, clean books equals peace of mind and opportunity. When you have clean books, it means you're audit ready. It reduces stress. It allows you to file your taxes with peace of mind. Everything is documented. You have clean books. If you have an investor, you want to apply for a loan, financials are ready to go. Right. Just a quick disclaimer. This content is for educational purposes only. Always consult a qualified professional for specific guidance. That's it for today's lesson. If this was helpful, consider sharing with a fellow entrepreneur. This is lesson 1 of a 13-part series. I'm Vanessa, CPA, founder of Biz Money Insights and Strategies. I appreciate you for watching this lesson. I will see you in the next lesson. Goodbye.